Hello, good evening, and welcome to the November TUSK M&A update. I'm so happy to have you all here. Thanks for joining us, and thanks for taking time out of your busy schedules for an update on the markets. It has been a fascinating time with everything going on in the broader U.S. Political arena and the U.S. economic world. To see how that is impacting dental M&A has been pretty fascinating. So really looking forward to unpacking that with you all tonight. As the title of the webinar reads, we are seeing really nice valuations today for our deals, but there is curiosity around how long this can last. So I wanted to unpack that with you this evening. As a quick reminder, as always, you can submit questions through the Q&A or through the chat. If we have enough time this evening, we will certainly get to those. But without further ado, I think we should go ahead and get started. There's just a lot to cover this evening. Again, for those of you who don't know me, I'm Kevin Cumbas, president and founder of TUSK Partners. I've got a background in finance, investment banking, and dentistry, and absolutely love creating transformational, multi-generational wealth events for our clients. Before we get started, I should really take a minute to thank our team. Our team is working tirelessly right now. The M&A business development M&A teams is working tirelessly. We're talking 12, 16-hour days. This is truly busy season for us. At this point, we have more deals in pipeline than we've ever had in the history of the business, and are on pace right now to be closing. Right now, it's about a deal a week. So thank you to each and every one of you for all you do for our clients. And it also, thank you to Mariana and Austin for all you do to make us look good here on these webinars. We could not be doing it without you. A little bit more about TUSK. I'm certain we are unique inside this space. There are hundreds of dental practice brokers out there, but what makes us different is the two sides of the coin. Side one being our vast history in finance, investment banking, private equity, and mergers and acquisitions. What you see on screen here are some of the companies we have collectively worked for over our professional careers, and the companies we work for in the dental space. We have team members who have been CEOs, COOs, founders, folks in business development, operations, and sales throughout some of the biggest and best brands inside of the dental world. And where the Venn diagram overlaps is really where TUSK lives. So it's, to interact with these people each and every day and get their unique perspectives to solve problems and create great outcomes for our clients is really a great pleasure. Finally, TUSK does one thing. There are groups out there who do consulting, do capital raising, do this, do that, and do M&A, but I think in order to be excellent at one thing, you need to niche down and focus exclusively on it. So we at TUSK each and every day maximize value for our clients by creating the best possible partnerships at the highest total value, so our clients can exit without regret. Enterprise value is important, headline number is important, structure is important, but how you feel the next morning after that wire has hit, when you look at your spouse and think about what the next day is going to be like, you need to do so without regret. And we know that by going through a marketed process, you can certainly achieve that. A little bit more about the team. If you've been on these webinars before, you've seen it before. Continue to add to the team. 13 today, probably have 14 by the end of this year, just scaling up to meet demand. And thanks to each and every one of you for all you do here at TUSK. All right, off to the agenda. We're going to cover three topics today. I was working on this morning and thinking through everything that we need to cover, and it really distills down to 3 points. One, let's get you all current on what's going on in the dental M&A markets. Two, we're going to talk about a story about the haves and the have-nots. And, I think about the haves and the have-nots from a seller perspective and also from a buyer perspective. On the sell side, it's a tale of two stories. One story is about the large transactions, big transactions. We're talking $20-25 million worth of EBITDA and larger, and how the current economic landscape is impacting businesses of that size that are looking to transact this year in this environment. And the second story is of those businesses that are smaller than $25 million of EBITDA, because those deals are getting done, and they're getting done with high velocity at good multiples, great partners with multiple bids. Yet on the top end of the market, the story is vastly different. So we want to tell the story of the sellers. Then we want to tell the story of the buyers. The buyers right now in our world are broken into three distinct buckets. And we want to talk with you about who's active, who can acquire, who's frozen out, who can't acquire, why they are in that predicament, and who's coming on the scene now that wasn't on the scene as recently as 6 months ago, that are making major splashes and creating big waves within our market that you all need to know about. And third, there's some strange things that we have seen from a limited number of buyers out there. I'm going to call them bad actors because I don't believe they are doing what is best for the companies and the dentists that they are attempting to partner with. Again, it's a small handful, but these are just the strangest things I've ever seen in the space that I can't not tell you about. So we've got a fun evening ahead of us. So let's go ahead and get started with the M&A update. So here at TUSK, we are busier than we've ever been. As I've shared with you, it is busy season. The fourth quarter is always busy, right? So last year, fourth quarter volume was driven primarily, I'd say primarily, by the looming anticipated tax changes. There were big promises from Biden's White House that we were going to see long-term capital gains rates almost double. And that was driving a lot of interest in selling businesses, not just dental businesses, but businesses of all shapes and sizes before the end of the calendar year, because there was fear that in this current year, 2022, that there'd be higher tax burden. So we were busier than we've ever been, and it was a little chaotic. This year will be busy still, but we don't have that same pressure. At the end of every year, there's just a need to close before the end of calendar year. So we're feeling that now. What's interesting about where our pipeline is, we have a lot of opportunities and a lot of new deals that will be coming to market in Q1 and Q2, and fully expect to see that continue for the time being. While there is high demand, we'll continue to have high supply of deals coming to market. Every deal we have in market today does have multiple offers. There are new buyers out there that are presenting themselves. There are newly capitalized private equity groups that are bidding on deals. And obviously the legacy DSOs are still there, really trying to bolster the size of their business, increase the geographic spread of their business, and take toeholds in new states and new geographies. In the specialty space, we are still seeing extremely high multiples. We just closed 2 rather large ortho opportunities down in the Southeast, and I was floored at the multiple that we were able to achieve for our client. The business just kept growing and growing and growing from the minute they signed on with us, through the execution of the letter of intent, on through the quality of earnings. And through that growth, client was able to achieve an astronomical exit multiple and a fantastic deal with an outstanding partner. And we're seeing this across all specialties, be it orthodontics, endo, oral surgery, perio, and even pros. There are more buyers for prosthodontic practices today, and I keep meeting these new business owners at the conferences like the DEO or Dykema. They're just coming out of the woodwork. So kudos to all the entrepreneurs out there, but it's good for all of you who are currently owning these businesses. There are lots of buyers out there for you. Newly formed DSOs are contacting us directly for deal flow. My text string is a little overwhelmed with it. So we're just know buyer demand is high. I alluded to this earlier, but we're going to see the largest first quarter in the history of the business simply because folks are a little concerned about what could be happening with interest rates and potentially with what's going on in DC. With the House and the Senate, we've got a looming presidential election coming up in 2024. We just had Donald Trump announced his candidacy for president yet again. So that uncertainty, forget about your political persuasion. There's a lot of uncertainty in the political world, is leading people to say, maybe now is the time for me to exit. Oh, by the way, markets are at all-time lows. Maybe I could use these proceeds, get into the market and do something productive, diversify my cash. DSOs are also scaling up. I see new announcements regularly that they're adding new business development team members, which means that they can more rapidly produce letters of intent, put unsolicited offers on your plate. Good for them. So we're just seeing the whole industry grow with new talent, great talent, all working towards creating great partnerships. But the negative piece we are seeing is some DSOs are bowing out. We yesterday were on the phone with a buyer who's been in the space for a long time, well capitalized with a private equity group that they've been working with, who called and said, hey, we just heard from our private equity sponsor, and we are no longer going to be able to bid on any multi-location groups. I mean, they are out of the game. So we believe this is an isolated incident. We're going to talk about this a little later, but there are some who are not as eager to move forward and in the market that they're in. We believe that this is isolated to them and their balance sheet and their business, and not a systemic issue throughout the industry. All right, let's talk about the haves and the have-nots. This is a piece I've been excited about. So think about the sell side here. I think about it in two distinct segments. Let's call it the larger enterprise level businesses, $25 million of EBITDA or more. These businesses of this size are typically sold to private equity groups. And many times, private equity groups that might not yet be familiar with the industry they are investing in. There are several deals that we know of this size and larger that were under letter of intent. And as they were going through diligence, the buyer got a little bit of cold feet because what they were seeing was inflationary wages. They were seeing a rising cost of capital, and they were not familiar with the history of dentistry. Right, we all now know that dentistry is effectively recession resistant and pandemic proof, but for a new investor, that was too much risk for them to take on. Right, this is one business they don't fully comprehend or understand, and they see some margin shrinking, they see cost of capital going up, and they're walking away from the table. That has been happening, probably since middle of this year. So as the buy side has started to dissipate, no one wants to go to market. There are two large deals that we know are sitting there waiting to go to market, thought they'd be in market now, are not in market now, and are really waiting for the macroeconomic landscape to change. I have spent a lot of time here in Charlotte taking breakfasts with investment bankers at bulge bracket banks. Think Wells Fargo, Bank of America, headquartered here in Charlotte, to get their read on what they're seeing for deals of that size. And what they're telling me is that the lenders in their world, the traditional lenders, have really just said, we've had enough. We just can't understand it. We don't know where the bottom is, and we're out. Now there are direct lenders who are filling the gaps with higher interest rates. think about it kind of an LBO model. But if you're looking to make a 5-year investment and really begin a new platform, those interest rates are unpalatable. Although you can refinance them off your balance sheet, and that's not the way you want to start a business. So we are seeing a lot of slowdown here. The bankers I'm speaking with say, look, this is likely going to be something that fixes itself in Q1 or Q2. There are people behind all these loans, right? So if the investment bankers and leverage finance at Bank of America aren't going to have a great year this year, and they're not going to hit their bonus, they're going to know that in January. And they're going to come out of the gate and say, well, I can't tolerate that again. And we believe we're going to begin to see some more lending at the high end of the range, at the top of the market, just out of pressure, right? So we expect to see a good Q2, certainly a good Q3, and a really, really strong through Q4 at the top of this market. So to recap, over $25 million of EBITDA is a little stagnant at this point, but under $25 million of EBITDA is a completely different story. So deals of this size and this magnitude, there's more than one buyer, right? Private equity groups certainly would invest in the business of $25 million of EBITDA, but these are also perfect tuck-in acquisitions for DSOs. We're seeing DSOs bid on $5-10 million of EBITDA to get them into a new geography, to diversify into a new specialty, and paying rich multiples to partner with that group. So there are multiple bidders on these deals. And if you just put yourself in a DSO shoes for a second, if you've got $60 million of EBITDA and you understand the risk profile of all those assets that are producing that profitability and EBITDA for you, to add another $10 million is not dramatically shifting the overall risk makeup of your business. So they're much more risk tolerant than a private equity group looking to invest in a platform. They have a different perspective that they're viewing that acquisition target through. As a result, valuations have remained nice and high in this segment of the sell side. Now let's look at the buy side. The buy side is actually split into 3 distinct segments. 1, legacy DSOs that have unfavorable credit facilities or scared private equity partners, right? This is the group that called us yesterday and said, no more multi-location deals until further notice. This could also be an issue with their broader portfolio companies. We've seen this before in where I worked at Affordable Dentures. We were owned by American Capital Strategies, and we're one of their many portfolio companies, and Affordable was doing extremely well, spitting off cash, and some of their other companies were not. And they needed the cash flow from our operations to get returns to their limited partners. So, maybe it's a private equity issue, maybe it's a fear issue, or maybe it's a balance sheet issue inside of a DSO. But I promise you, this DSO has LOIs out to multiple groups, and those deals are not going to get closed. It's all about who's in charge, right? So you meet the business development guy, you think that you got a great relationship with him, but ultimately the decision maker is the lender and the private equity group. When they don't have great credit facilities in place and their cost of capital is very high, it could be that the head of the DSO or the business development guy at the DSO says yes, the private equity group can say yes, but the lender says no. So the cost of capital going up is certainly slowing down some buyers. We got a quick example here for you to kind of help illustrate this with numbers. We love to show this stuff to you so you can gain the insights that we have. But I wanted to show you an example where we have a target here with EBITDA of $1 million. The bank is willing to lend this DSO 3 times the EBITDA for the acquisition. So the cash from the lender is $3 million, 3 times the million. So the DSO offers 6 times the $1 million for a total implied enterprise value of $6 million. Now, on the far right of this, you see the structure of the transaction. Keep in mind, DSOs don't like to use their cash on balance sheet. They really prefer to use any cash in a transaction that a seller is receiving. They'd love for that all to come from the lender. All right, back to structure on the right. The cash from the lender, as we know, is $3 million. But they're going to go ahead and dig into their pockets and pull some cash from their balance sheet, $500,000 to help this deal get done. And then they're going to ask the target to roll $2.5 million into equity. And that'll create a $6 million enterprise value. But when you look at the structure stacked up, you'll see that cash is close to 60%, equity is close to 40%. I mean, it just feels like you're taking on a lot of risk with your DSO partner here. We've had a lot of conversations with buyers who are telling us, expect to see different structures, expect to see less cash. And when you dig into that, they're like, look, we just don't want to put any money in the deal. And what that tells me is you don't have affordable capital at your disposal. You don't have a fresh stack of capital to lean into to actually get deals done, or you don't want to put your own money into it. So this structure, which we rarely saw a year ago, is now getting more and more common. If you took your deal to market, though, you'd have more than one offer at the table. And what you could see is an offer that looks like the offer from DSO number 2. It's the same target EBITDA. It's still $1 million of EBITDA, but the relationship that this DSO has with its lender is better for one reason or another. Potentially their balance sheet's in better shape. Potentially the lender is new in the relationship, is willing to lend more on this transaction as they build the relationship. There's a whole host of reasons this could be. But in this offer, the leverage ratio is 4.25 times the EBITDA of the target. So the cash from the lender is $4.25 million. The offer is still the same. It's still a 6x deal for an implied enterprise value of $6 million. But what is different is the structure of the deal. All right, cash from the lender, $4.25 million. Cash from the balance sheet. Here the DSO is still going to put cash from their pocket into the deal, equal to the DSO number 1 deal, but the equity roll is a fraction of what it is in deal number 1. Total enterprise value is the same. So when you stack it up, you've got cash of 4.75 or close to 80% of total enterprise value and equity of $1.25 million. Everybody is different in how they view their personal risk profile and how much equity they want to roll into a deal. But you can see how different these two are and how different the risk sharing is from these two offers. This is not to say don't roll equity into a deal or that equity is bad. Far from it. Like we firmly believe in the value of the equity of many of the DSOs out there. Not all, but many. But I think it's important for everyone who's on tonight to understand what's driving allocations. And if you're trying to do your own deal and you're getting pushback on why you can't take more cash at close, it's linked to the quality of the balance sheet of your potential suitor. Okay, look, I know that's a lot of numbers for a Thursday night, so thank you for indulging me. All right, so let's move on to number 2. All right, legacy DSOs with new stacks of capital. All right, so what does that mean? There are legacy DSOs, groups that have been around for years or decades that either recap their business, meaning the private equity group sold to a new private equity group and got a new credit facility, or legacy DSOs that have had private equity groups connected to them for a couple of years that got a new credit facility before we started to see interest rate rise. And we were talking to one DSO that is in that situation. They've had their private equity partner for about 2-3 years now, and they went through and got a new stack of capital about 20 months ago. And we were on the phone with the head of business development, and he said, the private equity sponsor has told me to treat these dollars like gold. They don't know if or when we will ever be able to get this type of affordable capital going forward. And as a matter of fact, if they went to market to try to get that same credit facility today, it would not be available to them. They couldn't get it. Not the interest rate, not the term, none of it. So, new credit facilities are either hard to come by or certainly won't have the same favorable terms as they did 24 months ago. But these groups have dry powder to deploy. They are actively out closing transactions today. They're competitive, they're winning on enterprise value, but they're also winning on structure, right? So just think about our former example, and just kind of bring it up here. $6 million enterprise value is interesting. A 6x multiple is kind of what you hear. You might hear that at a conference. That might be how you boast to your buddy about how much you sold your business for. But you can see how important structure is for how many dollars you might actually receive over the lifetime of that transaction. So that's why yes, they might be winning on price, but they are certainly winning on structure. And there are two huge DSOs that recently wrapped up their recaps, and they are on buying sprees. They're bidding on every single thing that we bring to the market. They are competitive. They are winning. These are great businesses that we've known for a long, long time that really have a distinct advantage compared to their peers. All right, so we've covered number one, right? These are legacy DSOs that are kind of stuck. They don't have the capital resources to get deals done in effective ways. Number two, legacy DSOs with a new stack of capital. And now number three, newly formed DSOs with a new private equity group and a new stack of capital. Believe it or not, there are still new DSOs being created each and every month. Sometimes it's 4 a month, sometimes it's 2 a month, but there are new private equity backed groups being created all the time. And there's over 150 today, and there will be more by the end of this year. Yes, there's consolidation at the top of the food chain, and American Dental Partners sold to Heartland, and you're going to continue to see some of that, but the big ones aren't consolidating as quickly as new ones are being created. And this is great news, right? Because when a new private equity backed group is built, they have to acquire additional locations to meet their growth targets and return to their investors what they expect to get, which is 20% compounded annually. You can't get that type of return through only organic growth. You're never, ever going to get there. So there are 4 groups that we know of right now that are putting the money to work like crazy. They've got goals for 2022 and 2023. And these companies kind of acquire in spurts as the new DSO is just being formed. They'll buy maybe a $2 to $10 million EBITDA deal. They'll work through a little bit of digestion of that business, but quickly on the heels of that are out acquiring again. And then they'll digest maybe 6 additional locations, and they'll go dark. Then they'll buy additional 6 or 8 locations, then they'll go dark. They go through sprees of acquisition and then integration, acquisition and then integration. So you've got to know who has the hot hand on any given month to know who's going to put the best offer on the table. So these are a lot of fun to work with. We've met some wonderful new folks in the space, some folks who have done this more than one time that are connected to private equity groups that have done this more than one time. So again, this is the third and really a unique group that's always been there. But again, they have a unique advantage over some of the legacy groups today. All right. Final thing of the night that I want to make sure everybody hears about are some of the strangest things we are seeing in the market. I'm going to go ahead and call these bad actors. I don't know what else to call them. It's confusing. It's a little frustrating. But I certainly want to share with you all what we see so you can be aware. So when you see it, you know it. All right. First, there are a small handful of groups out there that are sending unsolicited LOIs to doctors on what we have to assume is like some assumed EBITDA. They meet with the doctor, they ask for revenue, they might get some financials, and quickly are churning out letters of intent. I don't think they're doing the homework. I don't think they're actually digging into the numbers, and I'm not even sure if they care. I mean, we have, we regularly are on the phone with doctors and meet with doctors, and they say, look, I've got a letter of intent. It feels great. I'd like to do it. Can you help me out? We say, sure, we're more than happy to take a look at it. And we spend some time really digging into the numbers and understand that, profitability might not be as high as the DSO had thought. And we have run into one deal in particular where there was actually no EBITDA in the business after the normalized doctor compensation, and yet he had an offer for $6 million. What may be happening is that the DSOs are putting these offers on the table with and maybe getting the doctor's hopes up of doing a trade. And the doctor executes the letter of intent. And next thing you know, the quality of earnings comes back and they have to have a hard conversation. But potentially the doctor has already been spending the money mentally, or it's been bragging to his friends about his great deal, and is too emotionally attached to the idea of retirement or exiting. And then they sit there and they're at the crossroads and they get a hard decision to make. And if they want to do a deal, there's going to be a retrade on the economics. You can't pay millions of dollars for an asset that doesn't have any EBITDA. You just can't do it. So what we believe is happening, that there are retrades on the back end of these things. And we've been I've worked on 3 in the Southeast that didn't even come close. I mean, offers were 15 million, 12 million, and 8 million. And I, based on the work our team does, we can't even get close to that. So I wanted to show you the math of one of these that we've worked through recently. So you can be on the lookout for this. So there's actual revenue of around $4 million. We think that the DSO that was entertaining partnering with this group put an assumed EBITDA margin on this business of 20%. It's kind of industry standard. It's probably where we want to see most practices shoot for, but clearly not all get there. They assumed an EBITDA of $800,000, and they put an offer on the business of $5 million. Back of the envelope math puts this as at an implied multiple of 6.25 times. Look, not a bad multiple, a little lower than market, but that might be a deal that was a deal actually that got this doctor pretty excited. Then we ran the numbers, and what we discovered was something vastly different. We saw the revenue at 4 million, but the actual EBITDA margin was not 20. It was 8. And the actual EBITDA was 320,000, not 800,000. And if you hold that offer price firm at $5 million, it was an implied multiple of 15.6 times. I mean, this is a multiple reserved for Heartland Dental Care and Aspen Dental. This is not the kind of multiple you're going to see on a $4 million revenue business. So then we're left to pick up the pieces and tell the doctor, we don't see it the way they see it. If they are willing to pay you this and you think that they will, we encourage you to move forward with it. But it's our belief that this deal will never get done and you've got a retrade coming. I can't imagine a world in which any DSO, even the most well-capitalized DSO, would ever pay close to 16 times for $320,000 of EBITDA. We know some of the names of the companies that are doing this. Maybe it's just moving in haste. Maybe it's moving too quickly. Maybe there's nothing malicious about it, but we're seeing it all too frequently for it not to be a coincidence. So if you're sitting on an offer and want somebody to take a look, please let us know that this is something that's a little bit troubling to us. The other thing we're seeing out there is kind of what we'll call duct tape DSO 2.0 or PT Barnum deals. Everybody gets so excited about all the money that's sloshing around the industry and all the wealth that can be created if you only had 10 practices to sell. If you could only cobble together $3 million of EBITDA and sell it for 10 times. And we're seeing more and more showmen out there that don't know how to operate DSOs that are really performing a high wire act, right? That they're monetizing the Rolodex. The founder says, look, I got a lot of dentists. I know a lot of dentists. We're going to club all you up and I'm going to take you to market. And although you might be worth 4 or 5 times your standalone EBITDA today, I can get you a higher multiple. Oh, by the way, I'm only going to take a large percentage for the privilege of doing this, and you're going to take some, but not all of that upside. We've seen this before. We've seen some of these actually, some individuals monetize a Rolodex that actually has created a real sustainable business. And I think that's really created some copycats that shouldn't be doing this. We get calls from folks saying, hey, here's the deal. I went to a steak dinner and this is the way it's going to work. I'm going to effectively give them my business for the privilege of being a part of the roll up. And the good PT Barnum guys always do a little bit of fear of missing out, right? FOMO. And they say for the first 10 who get in, we're going to allow you to trade up to a higher multiple than the next 10 that get in, than the next 10 that get in. So they bake in that FOMO and try to get everybody all riled up to effectively provide their equity to this founder who's then going to take the group to market in the hope that they will be able to sell it to some buyer. Keep in mind, there's no interconnective tissue. There's no infrastructure. And at the end of the day, you have no ability to negotiate your own deal. You've signed up to move forward and entrust this quote unquote founder to look out for your best interests. We have received calls from some folks who have found themselves in this situation, got a little carried away, went ahead and signed the letter of intent, moved on a little too quickly, and now we're asking us, how in the heck do I get out of this situation? You are going to see more of this. You're going to see a lot more of this because a couple of these are going to make it, at least to the first exit. The question becomes, can they get to the second bite of the apple? So we are staying tuned on some of these deals, and I'm sure we'll be following up with you about with the update on who made it, who didn't, if any of them made it. So it's just something to be aware of. This is not building a sustainable business. This is a duct tape DSO 2.0. All right, let's shift gears real quickly and just talk about 2023. We're knocking on the door of next year. It's hard to believe we're almost there. Thanksgiving's right around the corner. Where do we think we're going? First quarter of the year is always a period of time where we have disequilibrium in the market, meaning there are more buyers for businesses than there are businesses for sale, right? This is kind of what you just saw in the housing boom recently. At least we saw it in Charlotte here. Someone would put their house on the market and there'd be a bidding war of 20 people trying to bid it up. And ultimately it would sell 20 to 30% above listing price. That same thing is what happens in the first quarter every year in our market to date. So there's going to be really, really strong demand in the first quarter and second quarter. We've already talked about the top end of the market and what could likely happen with lenders up there. And maybe we'll see the over $25 million EBITDA deals start to get done. But in that less than $25 million of EBITDA deals, you are certainly going to see a real opportunity to sell at above market prices in the first quarter and likely the second quarter, because supply and demand does drive pricing. Secondly, I don't want to talk about politics and get too deep into this, but politics do matter. Wall Street pays attention to what's happening in Washington, D.C. So we just had midterm elections, and looks like the Democrats kind of have control of the Senate. The House looks like it's probably going to go Republican, and we've got an election coming up in 2024. Oh, by the way, Trump announced 2 days ago that he now is going to run for president. I think we're in good shape for the next 24 months. Feels like we have a lame duck in office, and a lame duck Democrat probably will not have the ability to raise taxes. So that's a good thing. The concern is what's going to happen in 2024. And you're going to begin to see some unrest in the markets as we march towards that election date. So it feels like we're going to be in a valley of opportunity here for the next 18 months where there's relative stability to get transactions done. And then leading up to the election, depending on what happens in the primaries, it could go back to a little bit of a choppy market with lenders tightening up, their lending windows closing, a less voracious appetite from the buy side. You could see more people selling businesses just to exit out of fear of what's around the corner. Again, irrespective of what your political persuasion is, uncertainty is not good for the markets. So I feel like we're through this first wave. We're going to sort out the Senate vote down in Georgia, the House seats that are up, that are still up for grabs. But then as we get to 2024, I'm really curious and interested to see what's going to happen with Wall Street and the rest of really our market. Finally, the U.S. economy. You can't talk M&A without talking about the U.S. economy. We need to get to the bottom, right? We need to get to whatever the bottom is with the recession and the interest rate environment. We need to get there because the sooner we get there and the bottom is tested a couple more times, we will reach new normal. And I know new normal is like this post-COVID apocalypse term, but when I bought my first house, I think my interest rate was like 6.5%. And I felt really, really good about that because it's what I knew. It is what was normal at that time. We've been in almost a free money environment for a really long time. It's been too long. And it's okay for the cost of capital to go up, but what's not okay is for it to bounce around and have us not know whether or not we should invest and buy that new car or that new home or invest in that new business. That's the uncertainty that's leading to kind of the chaos we find ourselves in today. Hopefully the political decisions that were made, the votes that were all cast will help lead to more uncertainty. But as soon as we get to that bottom, all of my friends who run hedge funds have told me, buckle up, like we're going to be in for a nice run. Stock markets double pretty quickly after recessions like this. So I'm like all of you, I'm eager to get through it. I'm eager to see a return to normalcy, even though that new normalcy might be 6% interest on mortgages. Whatever it is, when we get there, feel pretty confident the U.S. economy is going to kick right back up. So this is more of a 10,000-foot view and the impact it's going to have on our markets going forward. That I think is a I don't know. It feels like something that is so pertinent and so current, and we just don't talk about it enough. We get micro all the time on these webinars, but it's worthwhile kind of pulling back and looking at the broader economy to think about what's really driving supply and demand inside of the dental markets. So that's it. That's time for tonight. I can't thank you all enough for joining me. I'm aware that we have some questions. Thanks to all of you who have submitted those. We will certainly get back to you in the next 24 hours. We will be hosting another webinar. We'll certainly do an end-of-year wrap-up in January, looking back on the year that was and looking forward to the year that is. So we can share with you some case studies from the year. We can share with you some historical comps and some successes, and maybe even have a couple of clients on to join us. But thanks again for joining us. I hope you all have a lovely Thanksgiving week. and a wonderful night.